Here's a quote from the Bank of Canada statement this morning. We've had a seismic shift in U.S. trade policy and a sharp increase in uncertainty. And with that news, the Bank of Canada hit pause. In its decision this morning, the bank held its key interest rate steady at 2.75%. And the reason might be a little bit more complicated than you might think. And by the way, this is the first time now in a year that it hasn't cut rates. It had a streak of 7 straight cuts totaling 2.25 percentage points. But here's what makes this decision today especially telling to me. The bank isn't just weighing inflation and growth. That's normally what you'd expect it to do. But this time it's laying out two distinct separate scenarios for Canada's economic future. Because right now, uncertainty is the name of the game. Tariffs, trade risks, fluctuating inflation. These are all forcing the Bank of Canada policymakers to think more in what-if scenarios. So I want to break down what is going on, why the bank is hedging its bets, what the latest inflation data reveals, and what this all could mean for the rest of us in 2025. I want to start with the numbers. The benchmark interest rate, that remains at 2.75%. No change this time around. Now, we did get an inflation report out on Tuesday. Headline inflation dropped to 2.3%, and that is down from 2.6% in February. That's below both the market expectations and also the Bank of Canada's own forecast, which was 2.5%. So on paper, inflation looks like it's cooling, right? And that might seem like that's a green light to the bank to keep cutting rates. But the Bank of Canada's Governing Council is also staring down unpredictable trade landscape. And that's too murky at the moment just to sort of put, navigation on autopilot and just keep running with what would normally be the status quo. The biggest wildcard here, no surprise, is tariffs, and more specifically, the U.S.'s unclear stance on its future trade policy. And because of this, the bank has done something pretty unusual. It mapped out these two separate economic scenarios in its monetary policy report. Scenario 1, if the U.S. keeps tariffs targeted and limited, growth in Canada might weaken temporarily, but inflation would likely hover close to the 2% target. So that would be considered manageable. But when we look at scenario 2, if the U.S. does escalate into a full-blown trade war with both Canada and China, then the outlook shifts dramatically. The bank right now is sort of penciling in a recession in Canada this year, alongside inflation rising to around 3%. So when I look at these two different scenarios, the takeaway is this. The Bank of Canada is saying in no uncertain terms that the next few months could go in very different directions, depending on how global trade politics unfold. Now, I want to bring the inflation side of the story a little bit more in detail here, because it's not just trade that's making things volatile. When we look at March's inflation numbers, that dropped to 2.3%, and that's a pretty big reversal from February's 8-month high, but this wasn't driven by a sort of a smooth economic cooling. This was shaped more by several short-term shocks. Gasoline prices dropped by 1.6%. They had spiked 5.1% the month before. OPEC confirmed that it plans to increase oil output, and that pushed crude prices down. Cell phone plans got a lot cheaper. Prices fell 8.8% there thanks to heavy carrier promotions. Now, on the flip side to that, we saw food prices jump to 3.2%, and that's largely because of the GST and HST tax breaks that have expired, and March was the first full month without them in place. Now, restaurants led the way in food inflation. They bounced back to 3.2% after being negative the month before. So what does this all tell us? Well, when I look at March's inflation number, we look at the dip there, it looks sort of more like a return to the baseline. I don't really see a sign of deflation pressure, I guess is what I'm trying to say there. Monthly prices, they did still rise by 0.3%. So that does show that there is still upward pressure in certain parts of the economy. This now puts the Bank of Canada in a tough spot. I mean, they're used to being there, I guess, but I think it's a really tough spot right now. You look at headline inflation, that is easing, yes, but when you look at the volatile energy prices, the aftershock of the tax breaks ending, and the unpredictable trade policy from the U.S., it's not a huge surprise that the bank sort of is pressing pause here and rethinking things, or at least thinking things over, looking at those two different possible scenarios. The markets had been pricing in more cuts, but now expectations are a little bit more divided. As of this morning, half of the market saw this hold coming. The other half was still betting on a cut. So let's look at what could happen next. And if inflation does hold steady, if the U.S. keeps the trade tensions dialed down just a little bit, then you would expect to see the bank perhaps resume their rate cuts a little bit later this year. If we see escalating tariffs, if we see more signs of that trade-driven slowdown, then the rate cuts cuts, they could turn into more of a defensive move just to sort of soften the potential recession. With the Bank of Canada laying out these two scenarios, it is a real signal. It's a message, I think, to the markets, to businesses, to households, that the road ahead is very uncertain. When you think about it, how often does a bank say, hey, we might hit our 2% inflation target or fall into a recession with inflation above 3%? And that is a massive range. So they're covering a lot of bases there. And it just sort of highlights just how many variables they're dealing with and are in play right now. So this report sort of might look like a bit of a cautious pause, but I see it more as a warning. It's saying don't get too comfortable out there right now. We're certainly not out of the woods. When we look at the next couple of months here, the next few months probably, that's going to be pretty critical. Again, if the U.S. sort of clarifies its trade strategy, I'm not sure that's going to be happening, and I'm not sure we can expect that. If inflation continues to ease without any new major shocks, we could see the rate cuts return as early as summer. But if those tariffs ramp up, if global supply chains start to feel the heat again, that could stall recovery, or that could even reverse it. What I'm hearing in this sort of two-scenario approach from the Bank of Canada is essentially a call, almost a plea for flexibility. It's kind of their way of saying we don't have all the answers yet, but we're preparing for multiple outcomes. Now, I'm curious, what do you think? Let me know what your thoughts are in the comments. Now, the next story today is about Canada's housing market, and it had another pretty rough month in March. According to the Canadian Real Estate Association, CREA, the national home sales dropped 4.8% compared to February, and that is now the fourth month in a row that sales have slipped. Since the recent high in November, they're now down 20%. CREA's senior economist, Sean Cathcart, he sums it up like this. Up until this point, declining home sales have mostly been about tariff uncertainty. Going forward, the Canadian housing space will also have to contend with the actual economic fallout. In short, we've gone from a slam dunk rebound year to treading water at best. And this isn't isolated to one region. Sales are down pretty much everywhere, hardest hit areas being Ontario and British Columbia. Compared to last year, March sales were down 9.3%. And it was the slowest month since March 2009. And some of you might remember March 9th, 2009, and the significance that that has in our economic history. Now, new listings, they did go up 3% last month. That tipped the sales to new listings ratio down to 45.9%. And there's a big drop from February's 49.7%, well below the long-term average of 54.9%. So that does definitely point to a cooling market. There were more homes for sale, 165,800 listings by the end of March. That's 18.3% higher than a year ago, although still a little bit below the typical average for this time of year. With inventory building, the months of supply rose to 5.1. That's the highest since the early pandemic days. So that means that buyers have more choice and that sellers have to be more realistic. Now, on the price side of things, we have the average home price across Canada, $678,331 in March. That's down 3.75% from the same time last year. The MLS Home Price Index also dropped 1% from February. That's the biggest month-over drop now since late 2023. Valérie Paquin, that's CREA's new chair, she puts it like this. While the trend of falling monthly sales has been observed across Canada for the last few months, there are still many regions where sales are high, inventory is near record lows, and prices are rising. Those are my stories for today's episode. And just a quick reminder, I do have also the Pulse newsletter that I put out every weekend. And that sort of summarizes a lot of what we've talked about on the video today. And it also adds some additional depth to your investing experience. So I would encourage you to scan the QR code on your screen right now and subscribe to the Pulse. As always, I do thank you for watching. We'll see you soon in the next video.